Welcome to the future. You're listening to the Consensus Network. Consensus Network. Consensus Network. With Buck Joffrey.
Welcome, everybody. This is Buck Joffrey with Consensus Network. It's been a while since we've done a pure Consensus Network show. We did Tone Bays a couple weeks ago, but that was on both Wealth Formula Podcast and Consensus Network. And during that, at that time, what we saw over the last couple of weeks, and who knows what it's going to be like by the time this airs, because this is being recorded the week before it airs. But we've had a fairly significant spike in Bitcoin prices. If you look in the last, less than a month, we're up like 25, 30%. And to the question, I think a lot of people are thinking about at this point is, well, is this a new Bitcoin bull run? Are we there? Is this, and there's a lot of, I think, fear of missing out, AKA FOMO. But the reality is, I don't know that listen, it could, hopefully it does end up being a bull run. The technical guys, the technical analysis guys, are kind of split on this. Tyler Jenks and Tone Bays, who was on, are still fairly confident in their predictions of having a floor that's below 3,000. On the other hand, there's plenty of respected folks on the other side who that already think the floor is in. So, what caused this recent drive up in the mid 5,000s? The answer is really nothing. Nothing's fundamentally changed. We're just seeing a lot of price action here. So who knows? I kind of am secretly hoping there's another dip down, under $4,000 so I can pick up some more Bitcoin. But I've been holding off because I dumped some just Bitcoin, not my alts, but Bitcoin that I bought a fair amount of toward the end of last year, and I got out at around 5,200, and so I was kind of hoping to pick it back up a little bit less than that. Anyway, the bottom line is that not a whole lot is happening with the market right now, but we're going to keep sort of, building a foundation at least every other week of continued education in the space. I think that's what you're seeing going on in blockchain and Bitcoin is regardless of what the price is showing you, we are having a significant advances in technology. The guys at Blockstream are doing amazing things with Lightning Network, et cetera. And even though over the past 14, 15 months of the bear market, the price has been awful, it's a much better technology than it was 15 months ago. So sometimes price doesn't follow right away. So anyway, this week we're going to have I'm going to play a interview that I did with a guy by the name of Mark Roderick. He's a leading crowdfunding and fintech lawyer in the U.S. Who has found himself in this space of cryptocurrencies, distributed ledger technologies. And I think he's got some really interesting insights. And when we come back, we're going to talk to him. Welcome back to the show, everyone. Today, my guest is Mark Roderick. He is one of the leading crowdfunding and fintech lawyers in the United States. Expanding on his in-depth knowledge of capital raising and securities law, Mark represents many portals and other players in the crowdfunding field. He writes widely. He writes a widely read blog, which is called crownedfundattorney.com, but it's with an ATTNY.com, which we'll have later in the show notes anyway. And that blog provides readers with a wealth of legal and practical information for portals, issuers, and investors. He also speaks at crowdfunding events across the country and represents industry participants across the country and around the world. Mark, welcome to the program.
Thank you very much for having me.
You bet. Now, tell us a little bit about your background beyond what I just told you. Of course, you're an attorney. You're presumably a securities attorney. How did you get involved in the cryptocurrency space? What got you sort of, in that direction?
Well, I was walking down the street one day. No. So my background, I've been practicing law a long time, and during my long and storied career, I've always represented entrepreneurs in all the stuff that entrepreneurs do. All kinds of contracts and buying and selling companies and starting new businesses and all that stuff. But one of the things that entrepreneurs are always doing is raising money, because capital, of course, is the lifeblood of all businesses, especially new businesses.
Yeah.
So always been heavily involved in helping people raise money. And so when that's how I got into crowdfunding. When the Jobs Act was on the horizon, I said to myself, this is totally cool and transformative and disruptive, and it's going to be really good for the economy and exciting. So this is where I want to be. So ever since then, for the last 5 years or so, that was sort of a natural outgrowth of representing entrepreneurs raising capital, because here was a brand new and much improved way, both for entrepreneurs to raise capital and for investors to invest in lots of good deals. And then the cryptocurrency space and the blockchain space sort of opened up and merged to some degree with the crowdfunding space a couple of years ago. In fact, I was signed up, this was typical. We signed up to speak at a big crowdfunding event in Los Angeles, and by the time we all got there, it was kind of half crowdfunding and half crypto and blockchain. So those two spaces have a lot of overlap. So of course, now in crowdfunding, I've represented a bunch of people doing, ICOs and tokens and that whole gig. So that's how it's all developed.
Yeah. So let's talk a little bit about that, because, you mentioned that a couple years ago you got involved in this because there was people who were interested, presumably in the blockchain space, of doing this through the Jobs Act, doing this through legal means, at least in the eyes of the SEC. But in reality, we had a lot of, Wild West stuff going on, right? And we had the whole ICO craze coming out, and there really wasn't any regulation around that. Are those days over? Do you ICOs as we previously knew them, are they now dead?
Well, I'm not sure that they're dead. I don't pretend to be smart enough to know whether ICOs are dead. What we went through wasn't a period where there wasn't regulation. We really went through a period where too many lawyers who should have known otherwise had drank too much Kool-Aid or something, and got themselves convinced that this new technology, was so new that it couldn't possibly be subject to existing regulation. And to many of us at the time, that was obviously not true. But if you were in Los Angeles, if you were in that area, well, you're in Southern California. So if you were in Southern California in 2017, in the summer of 2017, you were probably drinking the Kool-Aid too. And I don't mean you personally, but I mean anybody. So there were just too many people hypnotically wanting to convince themselves that, this was such a brand new thing that it wasn't subject to any of these rules. And it wasn't right then. It was obviously not right. And unfortunately, a lot of people got hurt because of that very poor advice. Now, ICOs. So let's distinguish an ICO from what today everyone is calling an STO, which is a security token, which really just means an offering of securities. Let's talk about ICOs in the way they were originally formulated, which is I'm selling a token, and I'm selling something that has utility, but that I don't believe is a security. And the example I always use, you're trying to raise money for a movie theater chain, a new movie theater chain, and you have two possibilities. The old-fashioned way would be to sell stock in your company, and A different way would be to sell little blue movie tickets, right? Little blue admission tickets. Those are tokens. And you can sell tokens to provide the capital for your movie chain. The question has always been from an investor's point of view. And again, and here I'm assuming these are real tokens. They're just little blue movie tickets. These are not securities, so forget all that legal stuff. Economically, the question has always been, are investors better off buying little blue movie tickets, buying tokens in somebody's network, than they are owning stock in the company? Now, I've always thought that for the most part, investors are better off owning stock for all the reasons that they've always owned stock, which is, you know, your interests as an investor are more aligned with management's interests and all that kind of stuff. But there's also, and that kind of seems to be where we're heading. We're just heading back to the norm. But I don't pretend to be smart enough to know there may be some circumstances where you'd rather own the blue movie ticket. You know, you'd rather own the token than stock. So I don't want to say ICOs of that kind are dead, but, you know, the bubble has certainly burst. The air has come out of the balloon, as we all know.
What I mean by that ICOs are dead is the way they were done, right? I mean, obviously, presumably right now, you can look at a lot of things that in the last year in particular, you know, we had a bunch of pre-sales that were limited to accredited investors, you know, Regulation D, 506C type stuff. But for the most part, I mean, the major, you know, the new stuff coming out there, you know, the Hedera hash graph or, you know, Dfinity or whatever, they're not really interested in taking the same kind of approach as, say, Ethereum did, which was, you know, very much a Wild West approach. So it seems to me, and correct me if I'm wrong, but that way of approaching it, saying that this is no longer, this is not something we need to really worry about, the law is much about, is probably not the case for any legitimate project going forward.
100% agreed.
Right.
100% agreed. Yep. That way of doing it had a short shelf life. It burned brightly like a Roman candle, but poof.
Yeah. Now, but as a corollary to that, and this is what I'm really curious about. Now, what happens to a lot of these tokens that violated the SEC rules before? Now, so for example, you have Ethereum, which was actually deemed by the SEC to be sufficiently distributed not to be a security, but that's not the case for a lot of tokens. And for example, you know, there's a significant concentration even in EOS, which raised $4 billion. So what happens to, does the SEC have to go back one by one and particularly focus on these big projects and go back and penalize them? And if they raised enough money, they survive? Is that kind of how it works? How does it work now?
No, I mean, the SEC really couldn't care less about these old projects. So many deals were done in the improper way. And the consequence is not that they're going to get in trouble with the SEC. The consequence, and you've seen this in a bunch of situations, is that the people who bought them, you know, let's say they bought it for $10 per token and now it's worth 50 cents per token or whatever it's worth per token, those investors now have a right to sue. That's the main consequence. And in many cases, they have sued. And as you know, there are lawyers around who specialize in those class action lawsuits, and they have made more money than anyone else just about in the crypto space. So yeah, it's not the SEC coming in. It's just that these people have an illegal offering.
Right.
And all those token holders have the right to sue, although the value is often not there to sue. But everyone knows going forward those things are securities, and everyone has to act accordingly.
There was a few projects that sort of try to avoid American securities law from the beginning, probably anticipating that this could be an issue down the line, and their operating company may have operated, really been based out of, say, the Cayman Islands or something like that. Are they immune from some of these lawsuits? It makes it a lot more difficult, at least, right?
Great question. They are, if they, for example, I represent a company, just began to represent them. I didn't represent them at the time. They had a Cayman Islands company, did an ICO, using Regulation S, no non-US investors. So yeah, those folks have no US consequences. However, the way those deals were done, they were, let's put it this way, I think they have real legal issues in all the other jurisdictions where they sold tokens. These things were being done, as you know, like a mill. There were these legal mills in the Cayman Islands doing these things, and yeah, it's wonderful. Okay, you didn't have any U.S. investors, so you're not going to be sued in the U.S. That does not mean that you are immune from lawsuits somewhere else. If that answers your question.
Based in the Cayman Islands, but you did sell to U.S. investors, can U.S. investors sue you then?
Sure.
They can, but they'd have to sue you in the Cayman Islands, right? And then
maybe not. I mean, maybe not. Now, in fact, I would say probably not. If you were selling into the U.S., I bet U.S. courts would exert jurisdiction over you.
Got it. So,
but isn't it? It's just interesting. If we had had this conversation even 12 months ago, this is not the conversation we probably would have had. We wouldn't have been talking about lawsuits and so forth. We would have been talking about all the world-changing stuff that these ICOs were going to accomplish. It just shows how quickly this market has changed.
Yeah, and I think in that regard, it has a lot of parallels probably to the dot-com era. I mean, there was the dot-com, 1.0, a lot of the crazy stuff.
Yep.
And when everything imploded, out of the ashes came the Amazons, and
absolutely right.
World. So I think that's probably, in my view, where we're looking at. So as I mentioned earlier, there's been a lot of there've been a number of specifically pre-sales in the last year. I mentioned Hedera. I mentioned a few others out there, and they're really focusing for the most part on what looks like the Regulation D 506C, which is limited to accredited investors. And as a reminder to people out there, it's basically people who make a little bit more money, $200,000 or $300,000 per year, $1 million in net worth outside of your personal residence, yada yada. The bottom line is, most of these companies are doing that. Meanwhile, as you mentioned, the Jobs Act, there are these other means by which, if people wish to raise money, they could. Regulation crowdfunding, AAA. I've got a friend who has who's got a fund that's open to anybody. I think it's a AAA, I think you call it,
Regulation A.
Yeah. And he's basically, he's got a $50 million fund in non-performing notes, right? Why not?
I might represent him. It's very possible.
My friend George Newberry.
Yeah, he's a good buddy and client of mine.
He's actually a very good friend of mine too. So
fantastic guy.
Yeah.
George is an exceptional human being.
Yeah, it's funny.
Great. Small world, isn't it?
It is a small world. In fact, I was calling him just before I was talking to you. But anyway, so George has got this fun. He's made it. He went really all in on this to do all the right things. Why, if you're trying to raise a lot of capital, is it just the expense part of it? Is it just more cumbersome? Why aren't more of these companies doing this?
And just to fill in your question, by doing this, you mean using Regulation A rather
Right.
than using Rule
Right.
506C.
Right.
And the answer is yes, it is just the time and cost. So a Rule 506C offering very fast, meaning a matter of a couple weeks or a week. They do Rule 506 offerings in a week. And a Regulation A offering costs or takes, let's say, 5 months. That, no exaggeration. So a week versus 5 months, and the cost is about 5 times as much cost to do a Regulation A offering. And the reason is, you didn't ask, but I'll tell you, the reason is that since our securities laws were written in the 1930s, one of several fundamental concepts has been rich people can take care of themselves because they can hire expensive lawyers and accountants and stuff, and non-rich people cannot. So when you use the term accredited investor, in our securities laws, that is a stand-in term for the concept of wealthy person.
Right.
So in 506C, you're only selling to wealthy persons, so the government doesn't care what you do, Wild West. Regulation A, you're selling to non-accredited people, non-wealthy people. So the government, in the form of the SEC, has to put its arm around people's shoulders to make sure you're not cheating them. So that is why Regulation A takes a lot more time and costs a lot more money. And that's why people, if you don't have to, people don't do it. Now,
Yeah.
George, okay, so there are 2 reasons to do it. One is non-accredited investors do have money, contrary to what people in Los
Well, and there's a
Angeles.
lot more of them.
There's a lot more of them.
Right.
Yeah, only a couple percent of the population is accredited. So when you're in Los Angeles or New York, you know, all your friends are accredited investors, or it can seem that way. But all across the great swath of the United States, most people are not accredited investors, and they still have plenty of money to invest. So one, they have money, but 2, and this is one of the probably the main reason George did it, if you believe, as George does and I do, that ordinary Americans should have the opportunity to participate in good deals and that they should not be reserved to the hedge fund managers and the hedge fund manager clients, then you may, and George has, put his money where his mouth was and taken the time and spent the extra dollars to make his deals, which are terrific deals, available to ordinary Americans. So there are great reasons to do it, but you can understand why many people do not.
Yeah. Cost compliance probably is probably more rigid as well, I'm guessing.
It is, for sure.
And those and all those things. And it makes you make a good point. And it's interesting too, when I listen to some of the other cryptocurrency podcasts, some of the, even Anthony Pompliano has a very good podcast. He's very prolific in this space. And he's always talking about how these laws are unfair to people who are not accredited. But the reality is that there are laws that make it very fair. We're just not using them.
That is absolutely true.
Right.
Now, what he means by that, and what, I hear this a lot, and, well, a non-accredited investor can get on a plane and fly to Las Vegas and spend all of his money, and the government lets him do it. So why shouldn't they let him buy cryptocurrencies and other securities? The answer to that, that's a great libertarian viewpoint, but the answer is that the government doesn't care whether casinos in Las Vegas survive. But the government cares very, very much that the American capital markets remain transparent and trustworthy, because after all, what led to the Great Depression was in part the collapse of the American capital markets. So the government has these laws. It's not, the ultimate purpose is not to protect the investor. It's to protect the capital markets themselves and the American public's faith in the capital markets, so that American companies can raise money. So there's a big governmental interest in protecting our our capital markets. It's not just coincidence that
Yeah.
the government does care about that and doesn't care about the casinos.
Right. Let's talk a little bit about exchanges.
Okay.
Platforms. What needs to happen for exchanges to become more compliant in the eyes of, say, American securities law?
It's not hard. That's the thing. And I mean, that's kind of the irony that has been true from the beginning of the crypto. All these people who did non-compliant ICOs, if they had spent $15,000 or $20,000, they're raising $200 million. If they just spent a little money, they could have been fully compliant. The same is true of exchanges. It doesn't take very much in the scheme of things to create a totally compliant secondary exchange. So just to pick a number, write a check for $50,000 and you will soon have a fully compliant exchange. You buy or create a broker dealer, and you file something with the SEC to register as a so-called alternative trading system, ATS, and there you go. And then you can have a secondary market for cryptocurrencies and any other kind of security that you want to.
The interesting thing to me about this whole issue and enforcement is that by the very nature of what we're talking about, some of these things don't have a centralized authority, right? I mean, if you talk about exchanges, for example, you have, a number of decentralized exchanges. What do you do with decentralized exchanges if they are not in compliance? I mean, how do you enforce anything if no one's really the owner?
Well, someone's the owner. Someone's always the owner, but
Or at least created.
Again, the big picture is all these issues are ultimately not SEC issues. I mean, that's what people think about. And when you read blog posts and stuff, people always say, well, the SEC is going to come in and lead you out in handcuffs. The issue with all these things is always private lawsuits.
Right.
And if you are running a non-compliant secondary market exchange, something that should be regulated and is not regulated, you are in effect going to get shut down as a result of private lawsuits, whether the SEC ever knows about you or not.
Well, let's focus on something that the SEC does have control of. A lot of people in the space, we're in crypto winter right now. Everybody's kind of trying to figure out if and when the next bull run comes and what's going to trigger it. One of the things that a lot of people have been looking forward to is the possibility of an ETF. Specifically, there's one with the Chicago Board of Options Exchange, VanEck Solid, so some very big names in the space. The decision has been delayed several times, put off, et cetera. Do you think that this type of thing is going to happen anytime soon, or do you think the entire crypto space is just not ready for it, and ultimately the SEC will find a reason not to allow it?
Yeah, I don't know. I'm not a super expert on the ETF question. My perception is that there are some technical issues around that the SEC cares about around decentralization and custody of securities and things like that. How does anyone ever know who actually owns it at any given time? So there are technical issues around it. I think conceptually there are no problems with it. If it weren't for these technical, even technology issues, the SEC would be fine with it. The concept of having an ETF, which is just a basket of securities, or in this case, a basket of cryptocurrencies that allows people to trade them. I don't think the SEC has any fundamental problem with that at all. I mean, you can have baskets of of commodities, wheats and pigs and all kinds of things. So fundamentally, it's an acceptable concept, but the SEC is having a hard time getting its hands around some of the just very prosaic issues, which is what the same reason it's having trouble in the Regulation A space, um, approving an offering of security tokens. Nothing to do with whether they make good investments for anybody. It just can't figure out some, like these custody issues are just driving everyone crazy. But conceptually, it's fine. And if the technical issues could get resolved, I wouldn't be surprised if the ETF were approved tomorrow.
Got it. You've been talking about utility tokens versus security tokens. Why don't you talk a little bit about how, so with utility tokens, the idea there is, so with security tokens, it's basically like owning stock. But specifically when you talk about utility tokens, it's like, for example, say you have why don't you describe a utility token, because there's lots of this, specifically like in the gaming space, et cetera. Talk a little bit about that.
Well, the best example that I come up with is the little blue movie tickets.
Right.
It's a token. Utility token is just something that gets you admission to something. Yes, in the gaming, it can get you 3 characters. Or it can get you a sword and a flashlight to, penetrate the dungeon. It's anything that just gives you admission, as opposed to being something that gives you rights of ownership.
Right.
And of course, the problem initially was people were selling things that they called tokens, but the tokens had all sorts of benefits that looked like ownership rights, and they were selling them with the hopes that they would appreciate, which looks like an investment. But think of the blue movie ticket. Gets you into the theater. That's all it does. That is a utility token.
So tell us more about your, what you're doing. Give us a little plug in terms of who you can help and how we can contact you and all that.
Okay. Well, as I say, I spend 127% of my time in the crowdfunding world and the fintech world generically. It means doing, offerings of all kinds, including, of course, a lot of real estate, but also tokens and crypto kind of assets, and helping people these days, as my conversation here would suggest, where we are in the market, helping people who might have been involved in some not quite perfectly executed ICOs, kind of turn that right. I'm involved in a number of those.
On the investment side too, like suing, sort of ICO.
Yeah, I haven't done that yet. I get asked, but I generally help people fix things that may not have been done properly before. And just in every conceivable niche of this market, in terms of how people can get a hold of me, the blog, which is where most people find me, is crowdfund, which is spelled the way it sounds, and then attny.com. Or if you didn't happen to have a pen and paper today, if you just type in Mark Roderick crowdfunding attorney, you will find me everywhere. And of course, all my contact information is on my blog. And if you do want to talk, I'm always willing to talk. I spend all day talking about crowdfunding and related topics. Shoot me an email, and we can set up a time to talk.
What's your email?
Well, you'll see it. It'll take from now until October for me to spell it right for everyone. So find it at the blog. Shoot me an email.
Sounds good. Well, listen, it was good talking to you, Mark. And again, small world, interesting. We both know some of the same people. But thanks for your time today.
Thank you very much for having me. It's been a pleasure.
Be right back. Welcome back to the show, everyone. Hope you enjoyed that. Again, it's just, at this point, just trying to continue to learn a little bit about this space and getting all of as much information as we can. I think, Mark, for those of you who are looking at this from a, larger perspective in terms of, whether you want to take this asset class seriously or not, he's a good guy to obviously kind of follow because he's been in the mainstream, and this is also a space that he is now closely involved with. So not a lot going on here. As I said before, the news is there's not a whole lot of news to report other than prices going up for not a clear cut reason. I do have one question that I'm going to answer. Again, if you feel like sending in questions, if you're listening, go ahead, go to consensusnetwork.io and fill out the forms there to ask some questions, and be happy to answer. There's also a way to record a voicemail there if you decide to do it that way. So here is the question. It's from Nick. He says, I am looking for a definitive answer on these questions. If tokens / coins aren't ownership in a company, what is the security in owning them? How are coins valued? Does it make sense to believe that, say, XRP, for example, will be acquired by a large multi and be converted to shares? Is that even possible? So, Nick, I think there's a lot of questions there. Fundamentally, I think the question that's most important is understanding. Well, first of all, the goal is not to get acquired by companies in cryptocurrency as a general rule. For distributed ledger technology, the idea for the most part is to eliminate the company and have people who own various cryptocurrencies ultimately be, not have a middleman, being able to exchange currencies or whatever it is, contracts, etc., without having, a company in the middle. So fundamentally, that's that kind of thinking is probably not likely. Specifically, when you talk about XRP, that's a complicated situation because, frankly, XRP, which is a cryptocurrency issued by the company Ripple, this is a controversial cryptocurrency. I mean, a lot of the purists, et cetera, and frankly, me, don't really even understand exactly what the point of XRP is. We know Ripple is a company that has a significant amount of investors from Silicon Valley and that own this company. They issued this distributed ledger called XRapid or XRP, and so it's not the best example in the world for trying to explain sort of the valuation of cryptocurrencies. But let me step back a little bit and take the most obvious cryptocurrency and talk about why, what is its value, and maybe just give you my perspective on that. So let's talk about Bitcoin. What is Bitcoin? Bitcoin is ultimately a blockchain, and so it's software, right? And it is, again, there's no company in between Bitcoin and the people who use or store Bitcoin. Bitcoin has ended up becoming valuable because of some things about it. It's some characteristics, and those characteristics are that there will never be more than 21 million Bitcoin. It's never been hacked. It really can't be hacked. It's something that you can custodian yourself and carry large amounts of across borders without necessarily needing suitcases or banks. It is immutable, meaning that it can't be changed. The blockchain, once things are in the blockchain, you can't go back and change that. It is the safest, probably, certainly the most secure cryptocurrency, and obviously the first one out there. So these are what people look at as the things that create value in this particular cryptocurrency that we call Bitcoin. So you may look at that and say, well, gosh, I mean, I don't get it, right? I mean, why does that, why does that, what you just talked about there, Buck, doesn't tell me what the underlying, value of it is? I mean, what is it secured by, as you said? Well, let me ask this question of you. Why is gold valuable? I mean, so the question to that ends up being that it's been believed to have value for thousands of years, and I don't argue that. I think there's truth to that. But what is it about gold in particular that gives it its value? There's something about gold that, it has to be mined just like Bitcoin. There's a finite amount of it. It's difficult. It costs a lot. It's difficult to mine. And so with that, in that regard, it's similar to what we talk about with Bitcoin. Gold is, it's got some properties to it, like corrosion resistance, and, it doesn't oxidize. It's pretty, So that's what. So I guess you could. What my point is here is that when you ask about Bitcoin and what is it securitized by, I think that specifically in the case of Bitcoin, it is the value of the software itself, right? And the fact that there is only so much of it available. So the purists in gold, I mean, and there actually are a number of people who believe, who are gold bugs who have become Bitcoin people. But, my point is here that those who have not, I don't think have really understood that the parallels here are pretty significant. The big difference, to me is that gold has been around for thousands of years. Okay, so what? I mean, that certainly gives it stability and all that. But anyway, the bottom line is that I think the way you have to look at this is that it is it is a different kind of storage of value with intrinsic value, much the way gold has. As for other cryptocurrencies, I think it becomes more challenging. And what the value is really comes down to, for the most part, I think, supply and demand. There are a number of projects out there that, frankly, should have no value, but they do. And those types of things are going to eventually go to zero. Probably most things are going to go to zero. But if you look at some of the projects that we've had on the show, for example, the one I think, well, let's talk about, for example, Ethereum. Ethereum has got value because it was the first smart contract, and that kind of software has significant value to people using it, building on it, etc. It ended up getting additional value simply because of the fact that people were using it in initial coin offerings, and that part is sort of not as big a deal anymore, so it may not get the same value proposition as before. But there's also a number of other projects out there that are sort of second generation smart contract type vehicles. Certainly EOS, although EOS is a tricky thing because it's hard to tell where the governance issues are with that. But then a couple of projects that will be, that you're going to start to see, like Dfinity and Hedera Hashgraph. These are the next generation smart contract things. So the power and value is in what they can do, right? Now, if you look at, because there's no ownership, central ownership, no business that owns all of this stuff, you can kind of look at it as owning part of a business, owning part of the software itself by, having cryptocurrency. So anyway, supply and demand in that situation is what is bringing up prices. We need to distinguish that from other tokens types. For For example, there's utility tokens. There are tokens that have a significant purpose, like Wax token, for example, using for gamers. So in the situation like that, again, it's a supply and demand issue, but that has a different kind of, it's a different kind of currency in the gaming world. So again, supply and demand. And then there are actually tokens, the stable coins that, you're going to see. You already see a bunch of them around. And then there's the Gemini US dollar coin. And I think Coinbase has got one, or they're going to have one. There's a bunch of these decentralized ones, which really aren't cryptocurrencies. They're just sort of digital money, US dollars. And the purpose of those is to be pegged to the US dollar, but to serve the purpose of eventually probably replacing the whole wiring and Swift code and all that stuff that's so expensive to do. So in a nutshell, hopefully that kind of summarizes the different kinds of value propositions for coins and tokens. But it's a very difficult question, in part because I think every project and every blockchain has a very specific niche. And so is it a value of, is it a storage of value, or like Bitcoin? Is it a smart contract platform like Ethereum or EOS? Is it for micropayments like Hedera Hashgraph may be? It's hard to say, but so you can't really lump them in as much as it would be nice to be able to think of all cryptocurrencies. They're all pretty different. Anyway, that is it for me this week on Consensus Network. Thanks for the question. Make sure you leave your questions at consensusnetwork.io. Check out the website. There's some educational stuff there as well. If you feel like starting to buy some Bitcoin, I don't know what to tell you. I don't know. It's a tricky thing. I was thinking that I would probably continue to drop and I'd buy, under 3,000, but I also believe that Bitcoin is going to be something that's going to be worth a lot of money in 5 years. So I don't know, maybe it doesn't make a difference if you're buying a little at 3,000 versus 5,000 if it goes to 50,000. So again, that's it for me this week on Consensus Network. This is Buck Joffrey signing off.